Hi, Kumar here, and now we're going to be going over the Strategy 1 trade management. So now for the long trade management, we're going to be moving our stop to break even, which is the entry price, when the profit in the trade equals the risk that you've put on in the trade. So when you are in profit, the same number of pips you risked on the trade. This is going to happen when the CD leg has moved 50% of the AB leg. So if we look at this diagram, we see there's the A move to the B, then B down to C, and then the C going up to the potential D point. So when price has gone up to 25% of the A to B move, we enter. We've put our stop below the C point, but then when price moves up 50% of the A to B move, we will then take our stop from point C and move it up to the break-even point, which is the entry price. So what we're actually doing at that point is we are protecting our capital when the move has gone up this high. We want to protect our capital and we want to move our stop to break even. So if price comes back down from that point to this price here, we're going to be breaking even, so we're not going to lose any money. Now, I just want to make a note of something. The 50% mark is displayed as the same price as point B. Now that's only because we've taken the scenario where this B to C retracement is 50% of the A to B move. Any larger retracement here, so if it went any lower here, it would mean that the break-even line would be lower, so it would not be equal to point B. So in other words, this break-even line obviously is just dependent on however low this retracement point C goes to. So all you're simply doing is working out what 50% of the A to B move is from point C, and that is your break-even point. It can vary depending on this retracement at point C. So what we're then going to be doing is we're going to take the whole position off at point D of the AB equals CD formation. So we've got the A, B, C, D move, and this is AB equals CD. Obviously we're looking for, from point C, we're looking for the exact same number of pips run up as there were from A to B. Hence the AB equals CD formation. So our stop is at the break-even point, which is the entry price, once price has come up to the 50% mark. And then as price goes up, we are going to take the whole position off at point D, and we determine point D by looking at how many pips there are from A to point B and working out that same number from point C upwards. So if A to B was 100 pips, we will look to take all of our profit off at 100 pips higher than point C. And that's where we would take all of our position off, meaning we would sell our long position. Now looking at the other way around, which is a short trade management, it's exactly the same but just the other way around. So we're going to move our stop to break even, which is the entry price, when the profit in the trade equals the risk that you've put on in the trade. So when you are in profit, the same number of pips you've risked on the trade. Now this is going to happen when the CD leg has moved 50% of the AB leg. Now obviously short trade management, we're looking at the price going down. So A, B down, B to C up, and then C to D going down, and we're expecting price to go down to the D point. So when price has moved from point C 50% of the A to B move, so if the A to B move is 100 pips, when price has moved down 50 pips, which is 50% of 100 pips, at that price we're going to move our stop from point C down to the entry price, which is our break-even price. So if price moves back up now to that price, we are going to come out at break-even. We're not going to lose any money. Now again, the 50% mark has been marked as the same point as point B, but this is only because we've taken the scenario that the retracement at point C is 50% of the A to B move. Now if that retracement varies, so if the retracement is 60 or even 70%, then obviously this 50% mark is going to move higher and it's not going to be equal to B. So the point I'm trying to make here is it's not always that the break-even point is at point B. It depends on the move from A to B and how much the price has retraced to point C of the A to B move. So you just simply work out how many pips there are between point A and point B, and wherever point C is, work out 50% of that A to B move, and that is your break-even point. If that scenario is just like this, where the C point is a 50% retracement, then yes, the 50% mark will be point B. But please work out what this 50% move is dependent on where point C is. So work out A to B, how many pips there are there, take 50% of that number of pips, and that's the break-even point from point C downwards. Now what we're going to do after that is take the whole position off at point D of the AB equals CD formation. So we've got the A, B, C, D move down. We are entering when price moves down 25% of the A to B move. Then at the 50% of the A to B move, we are going to move our stop from point C down to the entry price, which is our break-even price. And then we are going to remove our full position off at point D, and we work out point D by first working out how many pips it is from point A down to point B, and then working that exact same number of pips down from point C to wherever point D would be, which will be that many number of pips as they are from point A to point B, and we will then take off our full position, meaning we will buy back our short position at that point D. So that's a trade management for strategy 1. Now let's look at the trade overview so we can put together everything that we've just gone over. This is Kumar for Trade to Success University. Now if you go over to the next page, you can continue with the training where I'll cover the trade overview in the next video.